The Fed just blinked. GDP just missed. And euro to US dollar is sitting on a knife's edge. There is a 4.5 billion euro option expiry sitting at 1.1500. That is a ceiling, unless bulls have the firepower to smash through it. The play is simple. Above 1.1483 with volume, you chase the breakout. Rejection at 1.1530, you fade the move and catch the mean reversion. I have 2 scalp entries and 1 swing trade with exact levels in the full breakdown. The euro just posted its best day since March. The Fed left rates unchanged. GDP missed by a mile. And yet, euro to US dollar is stalling at a level that has rejected buyers for 6 straight weeks. There is one danger zone and one hidden opportunity right now. I'll show you both. The headline says the dollar is collapsing. The reality is far more complex. A 4.5 billion euro option expiry is sitting at 1.1500. That is not a typo. 4.5 billion euros in option barriers that could either act as rocket fuel or a brick wall. Stay to the end. I am giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything. Here is the session bias. Bullish above 1.1483, bearish below it. This is a breakout or fakeout day, plain and simple. Write this number down, 1.1483. If we break and close above 1.1483 today, the entire multi-week range structure resets and we are looking at 1.1557, then 1.1600. If we reject, the path of least resistance is back to 1.1422, then 1.1394. Here is where the herd is positioned. Retail is overwhelmingly long after the Fed-driven rally. Short interest has been squeezed out. And that is exactly what makes this dangerous. When everyone is leaning the same way, the market loves to punish the consensus. The options market tells us the big money is hedged at 1.1400 and 1.1500. That means the real action happens when those levels get tested. This is not a trend-following market yet. This is a range that is about to explode one way or the other. Just this morning, Continuum Economics flagged that Eurozone GDP came in at 0.4% quarter-over-quarter versus 0.2% expected, with the year-over-year reading jumping to 1% against a 0.5% forecast. That is a massive beat. And on the other side, US GDP limped in at just 1.5% annualized, below the 2.1% forecast. The divergence is real. But the price action is telling us something else is going on. Let me walk you through the chart from the top down. On the weekly time frame, euro to US dollar remains neutral. We are still within the descending pitchfork that has contained price action since the May high. The monthly trend is neutral. But the daily, that is where things get interesting. The daily trend is a strong buy. The 4-hour is a strong buy. The 1-hour is a strong buy. Every time frame is aligned to the upside. And yet, price is stalling. Look at the moving averages. Price is trading above the MA5 at 1.1451, the MA10 at 1.1430, and the MA20 at 1.1430. The MA50 sits at 1.1429. That is your dynamic support. The MA100 is at 1.1405 and the MA200 at 1.1404. All 12 moving averages on investing.com's technical summary are showing buys. Every single one, but here is what most traders miss. The RSI on the daily is now at 73.075. That is overbought territory. The Williams %R is at -9.709, deep in overbought. And the CCI is at 129.22. So while the trend is strong, the momentum is stretched. That means we are vulnerable to a mean reversion if the breakout fails. On the 4-hour chart, price is coiling just below the critical 1.1483 resistance zone. This is the level that forex.com has been flagging for weeks, defined by the 1.618% extension of the April decline and the November low day close. Above that, the next resistance is at 1.1528, which is the June 18th high. And above that, we have 1.1557, the June 12th low, and 1.1600 on the downside. Immediate support is at the 20-period EMA on the 1 hour, which sits around 1.1422. Below that, we have 1.1394, the breakout level from the ascending channel. And the key invalidation level is 1.1355, the 38.2% Fibonacci retracement of the 2025 rally. If we break below that, the entire bullish structure collapses. Here is a fresh insight. Just this morning, the Japanese yen's sharp decline against the dollar spilled over into euro to US dollar buying, pushing the pair to 1.1530 before settling back. That tells you the move is being driven as much by dollar weakness across the board as by euro strength. And that is a fragile foundation for a breakout. The MACD on the daily is showing a bullish crossover with positive momentum. But on the 4-hour, we are starting to see divergence. Price is making higher highs while the MACD histogram is shrinking. That is a classic warning sign. If you are long, you need to watch this closely. Let's connect the dots on the macro picture. The Federal Reserve kept rates unchanged at 3.50 to 3.75% for the 5th consecutive meeting. But here is the kicker. 3 FOMC members dissented in favor of a 25 basis point hike. That is not a united front. That is a committee at war with itself. And the market noticed. Front-end Treasury yields dropped sharply as traders unwound hawkish bets, sending the dollar tumbling. But don't get too comfortable with the dollar bear narrative. Overnight index swaps are still pricing around 50 basis points of tightening by June next year. And markets are pricing a 70% probability of a Fed hike in September. The Fed may have paused, but the market still expects them to hike again. Now look at Europe. The ECB delivered its first rate hike since 2023 on June 11th, lifting the deposit rate to 2.25%. Eurozone Q2 GDP beat expectations across the board. Germany and Italy both expanded by 0.2%, while Spanish growth surged to 0.7%. And inflation is firming. Spain's flash July HICP came in at 3.8% from 3.6%. The market is now pricing a 2/3 probability of an ECB follow-through hike in September. So we have a policy divergence battle. The ECB is hiking. The Fed is pausing, but the market expects them to hike again. That is a messy narrative. And that is why euro to US dollar is stuck in a range. But here is the geopolitical wildcard. Renewed military strikes in the Middle East are pushing energy prices higher. Brent crude is above $100 per barrel. That is inflationary for the US and deflationary for Europe, given the region's dependence on imported energy. The safe haven dollar bid is stubbornly persistent. Every time geopolitical tensions spike, the dollar finds support. And that is the X factor that most retail traders ignored. Do you think the dollar breaks 105 this week? Comment yes or no. I am tracking consensus.ing is now arguing that euro to US dollar is likely to trade in a 1.14 to 1.15 range, with a more sustainable dollar setback depending on sustained lower oil prices and softer US jobs and inflation data. That is the key. The Fed's next move depends on data. And the data is conflicting. Weak GDP but sticky inflation. That is a stagflationary mix that gives the Fed no easy path. Most people skip this section. That is exactly where the money is made. Keep watching. I am giving you 2 scalping strategies and 1 swing strategy. Every single trade has exact triggers, stops, and targets. Write these down or screenshot the screen. Let's go. Strategy 1. The opening scalp, scalping, high probability. This is a 5-minute structural trigger right at the key intraday level. The setup is simple. We are looking for price to pull back to the 1.1425 to 1.1445 zone, the area where the 21-period SMA on the 5-minute sits alongside the broken ascending channel resistance that now acts as support. When price taps that zone and prints a bullish engulfing candle on the 5-minute, we enter long. The trigger condition is precise. A 5-minute candle close above the high of the previous candle after touching 1.1425 to 1.1445. That confirms buyers are stepping in at support. The stop loss is tight, 15 pips below the entry, At 1.1415 take profit 1 is at 1.1480, which is the 50-period MA resistance on the daily and a key intraday liquidity level. Take profit 2 is at 1.1520, the June 18th high and a major seller resistance area. The risk-reward on this scalp is approximately 1 to 1.5 for TP1 and 1 to 3 for TP2. What voids the scalp? If the 5-minute candle closes below 1.1415, the structure is invalidated and we look for a different setup. Strategy 2. The liquidity grab, scalping, counter noise. This is the counter trend scalp that catches the stop hunt. And it is the most profitable trade of the day if you get it right. Here is the logic. There is a massive option expiry at 1.1500 worth billions of euros. The market will try to squeeze price up toward that level to trigger stop losses above the recent highs and pin the option strike. But once that liquidity is grabbed and the options expire, the market often reverses violently. We are watching the 15-minute chart. The trigger is a fake breakout above 1.1528, the June 18th high and the key seller resistance area. If price spikes above 1.1528, triggers the stops of trap shorts, and then snaps back. Below 1.1528 with a bearish engulfing or shooting star candle, we enter short. Entry is on the snapback confirmation, a 15-minute close below 1.1520 after the fakeout. Stop loss is placed just above the wick of the fakeout, at 1.1545, which is above the 200-hour moving average near 1.1543. Target is aggressive and fast. We are looking for a quick 15 to 20 pip descent back to 1.1500, which is the option strike level and the nearest intraday liquidity pool. The risk-reward on this scalp is approximately 1 to 1. Warning. This requires fast execution. The fakeout can happen in minutes and the snapback is even faster. If you are not watching the screen, do not take this trade. The liquidity GROB entry at 1.1520, 15M bearish engulfing after fakeout above 1.1528. Stop loss at 1.1545. Take profit 1 at 1.1500. Risk and reward ratio is 1 to 1. Invalidation void. If 15M candle closes above 1.1545, are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3. The session swing, trend alignment. This is the multi-session trade based on the 4-hour and daily bias. The setup is for a trend reversal long. We are looking for a 4-hour close above the 60-period moving average on the 4-hour chart, which sits around 1.1470 to 1.1480. But to confirm the breakout, we need a high volume breach above the critical overhead resistance at 1.1483. This is the level that forex.com has identified as the key inflection point, the 1.618% extension of the April decline. Entry is at 1.1495. A buy stop order placed above the resistance to catch the breakout with momentum. We only enter if the 4-hour candle closes above 1.1483 with conviction. No close, no trade. Stop loss is placed below the monthly support level at 1.1390. This gives the trade room to breathe while keeping risk manageable. Take profit 1 is at 1.1580, which is the 7/8 Murray level and a key upside target. Take profit 2 is at 1.1660, the major horizontal trend structural point and the 61.8% retracement of the July drop. The risk-reward on this swing is approximately 1 to 3.2. Trailing stop rule. Once price breaks cleanly above 1.1535, drag your stop to break even. That locks in the trade at no risk. The invalidation level that would shift the medium-term outlook is a daily close below 1.1355. The 38.2% Fibonacci retracement of the 2025 advance. If that happens, the entire bullish structure resets and we look for shorts. The session SLNG entry at 1.1495, for H close above 1.1483 with volume. Stop loss at 1.1390. Take profit 1 at 1.1580. Take profit 2 at 1.1660. Risk and reward ratio is 1 to 3.2. Invalidation void. If daily close below 1.1355, never risk more than 1 to 2% per trade. Scalps demand even tighter risk. These are high probability, low risk trades. No positions through high impact news. The US PCE data and Eurozone CPI are the next catalysts. Stops are non-negotiable. This is how you survive to trade the next big move. Let me summarize the single most critical level for the next session. 1.1483. That is the line in the sand. Above it, we are targeting 1.1557 and 1.1600. Below it, we are looking at 1.1422 and 1.1394. The hidden opportunity today is the option expiry at 1.1500. If bulls can absorb that selling pressure and close above 1.1483, the path to 1.16 opens up. If they cannot, the fakeout sets up one of the most profitable mean reversion trades of the week. The next focus, US PCE inflation data and Eurozone CPI flash estimates. These are the numbers that will decide whether the Fed's pause holds, or whether the September hike narrative strengthens. If US core PCE comes in hot, the dollar could stage a sharp recovery. If Eurozone CPI surprises to the upside, the ECB hike narrative intensifies and the euro could break out decisively. If this level breaks, the whole monthly trend flips. I will have the updated blueprint 24 hours from now. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.